people enter the room, that will be fine. So welcome everyone to the Experimental Conference and every judge out there. I'm Mark Mason, an L2, and I'm currently a COMAD, as I call it, meaning I am being a nomad during the coronavirus in the mountains of North Carolina. Is just absolutely lovely what I'm seeing. Now, I know that I have a 10-second delay between whatever I might be seeing in the chat room, so feel free to remind me if I've gone too fast through something. I will be asking to save the more detailed questions until the very end, but by all means engage at any time throughout this presentation, and I'm thankful to everyone who is here, and just know that I can read all of the chat remarks. So with that said, let's go ahead and get started with an attitude of gratitude. I know that's how I like to start a lot of things, especially right now when things can seem a little sideways for us in a lot of other ways. And with that said, I want to start by thanking Isaac King. Sincerely, I believe that Isaac King is a program treasure. If there's time remaining, I'm happy to share some amazing stories of interactions I've had with Isaac. But the way that he has leveled up and brought these conferences and increasingly pushing the limits of even the tools, such that we're now streaming on YouTube because there couldn't be enough people to watch live and direct inside of the Discord. What Isaac is doing is just an absolute and complete blessing to the entire community. Similarly, I would like to thank the Judge Academy. Beyond their recent decision to delay dues for the 2021 upcoming year, the flexibility and thoughtful decision-making that they've shown by supporting digital conferences is a real boon. It allows us to stay as sharp as possible while also having another way to inject some value into the community. And then finally, I'd like to thank the other presenters. I see some of them are in the chat room right now, so that's fantastic as well. And really everyone who's come to put this together, and that really leaves the most important thank you to you. Those of you who are listening live today are really sharing your time, and this is not something I take for granted. And that's why we're going to move at a strong pace and save those questions to the end. I'm happy to stay with you even days after the conference if you have some more detailed questions on some of the aspects of this wealth building strategy that I'm going to do a little, an ease into. But if you want to get a little deeper, I'm happy to get deeper with you. So before we dive in, this presentation is for education only. I am not giving tax advice. I've made the best effort to ensure that everything I'm telling you is true and accurate at the time that I'm saying it. I was unable to verify that everything I am saying is true also for Revenue Canada, but at one time, the things I'm saying were also true of Revenue Canada to the best of my understanding. So please, before you take on any tax strategy whatsoever or a position on your income taxes, please verify and use experts who have the right credentials. I will also say that I have used these same strategies and their offshoots to accumulate some sizable or noteworthy amount of wealth, especially the ones about creating business entities and separating assets. I have used those in different aspects of my professional life, entrepreneurial and investing life before becoming a judge. And I also want to share that a number of those strategies are not really life choices that I would make anymore in my life. I have different perspectives, and I'm happy to get into those. But one of the things that I believe, even as a person who criticizes capitalism and recognizes that there may be no ethical relationship that one can have with either consumption or wealth building while in a capitalist outcome, I also believe that an empty plate feeds nobody. And as long as we're going to have this system imposed upon us, it is worthwhile to at least understand the rules so we can make smart decisions about how we want to interact. But with that disclaimer in place, we have some objectives for today. Our first objective is to identify the two reasons for tax overpayment. And I'll share with you in a moment exactly how much the average person is overpaying. Objective number two will be to discover what I call the pizza pie principle and what a pizza pie actually has to do with tax law and how much you could be saving if you simply change slightly the way you're doing things. Objective three is we're going to visit friends and vacation tax-free. So we're going to use our judging to make our lifestyle more deeply enriched and keep a little bit more of the money that we make judging. And objective four, we're going to turn into percent signs. So I like to say turn dollars into percent signs, and we're going to do it in your favor long term. So here's an important question, and I'd love it if people would put answers in the chat room. Very likely when you were certified as a judge, you were asked, why do you want to be a judge? And so I'm going to ask that same question now. Why are you a judge? So go ahead and type those answers in as you go. I've given sort of an amusing answer on the screen. I love those wonderful cards that we get when and whilst judging. So that's just absolutely fantastic. If anyone wants to give some answers, there we go. We've got Christopher. This is something we will not be doing. We will not be cooking the books, but we will be taking a deeper bite and getting a little bit more than we used to. So just some reasons that people are judging would be great, but I will go ahead and move on to the next slide because there actually kind of is a trick here. You see, the trick is if your reason for judging is because you want to oh, how do we say? You want to oh, here we go. Here were some answers that came in. So Ian says that they enjoy working large events and explaining the rules to players. Absolutely consistent reason. Lots of people will say it is because of, they want to give back to the community. Or many people will say, they had a deep appreciation for the rules and they wanted to be able to share that with others. I'm here to tell you something very important. As it relates to this question about keeping more of your money as a judge, there is one and only one answer that matters. You are judging to make money because your intent deeply matters. And this is your right. It is your absolute privilege and right to keep as much of your money as possible. In the legal opinion of the Supreme Court of the United States, Justice George Sutherland, writing in Gregory versus Helvery, said, the legal right of a taxpayer to decrease the amount of what otherwise would be their taxes or altogether avoid them by any means in which the law permits cannot be doubted. So this is your absolute and sincere right. You may have seen the headlines recently from the New York Times, and if you looked at them very closely, this was about content warning, the president's taxes. The headlines would read, the massive tax avoidance of President Trump. And notice they did not say tax evasion. Tax evasion is the legal activity, the illegal activity. Tax avoidance is the legal structuring of your decisions to save as much tax as possible. But here's the bad news. We're doing it wrong. A full 20% of eligible Americans miss out on a tax break worth $6,269 each year. Now, that's the actual money coming back. So the deduction was even bigger, depending on what that average tax rate is. This is sourced from Newsweek in the article, Why Most of Us Pay Too Much in Taxes All Year. This was from January 14th of 2017, the statistic came. Now, if you think about that, an extra $6,000 a year is an extra $500 a month. What you may or may not know is that a whole 50% of the families who have gone bankrupt said that they could have avoided bankruptcy if they had just an extra $200 to $500 a month. So simply by learning how to do these things, you really can give yourself quite a financial protection. So why are we overpaying on our taxes? Well, there are two reasons. The first reason is fear. And the second reason is a lack of specialized knowledge. So what's all this fear about? Well, it's the IRS. I mean, a lot of us understand that the government has power. They have a monopoly on violence. They get to set the rules. If they say, as they had in the past, that slavery was legal, owning slaves was legal, freeing slaves was a crime. They have the power. But what's interesting is, despite the fear of the IRS, it may be, well, dramatically over experienced. The number of returns that are audited is 0.5%. Now, get this. The Lexington Law Survey showed that 25% of taxpayers fear being audited, even though only 0.5% will. And fundamentally, this fear is misguided because there are two kinds of tax audits that account for that 0.5%. There are what are called correspondence audits, and this is where you'll get a phone call or a letter, and it will say, hey, can you tell us a little more about this thing on your taxes? Or, we noticed you didn't pay any capital gains taxes, but your investment account said you sold these stocks this year. What's that all about? And they'll just ask you to clarify. That's also called an audit. And then there are, of course, the more detailed in-person audit. The correspondent audit is the most common, but it is still worth pointing out. Most of these audits, they simply are asking you to verify. So the fear may be slightly misplaced. But the other reason we have the fear is actually the other reason we overpay, is a lack of knowledge. And it's understandable. The IRS tax code is a little over 4,000 pages. And there are 70,000 pages of IRS tax opinion and past tax law. You could have information from wrong years and have applied it to this. So that's pretty complex. And the tax code does exist to generate revenue for the state. That's one of its core purposes. Some of that complexity is to their advantage. The other reason there's the complexity is sort of the second reason that the state has a tax policy, and that is to support certain social structures or to advance certain social policy. This is why there'll be tax advantages, let's say, if you are filing as a couple, or if you are a couple and have children, because the state understands it has an interest in creating the staying power of families. It also wants to encourage charitable giving. So that's the reason, charitable gifts can be a tax deduction. Now, it is because of these two reasons that tax policy exists, to make revenue and to kind of structure or impose social policy, that a lot of the ways that the tax law works can be counterintuitive. Before giving an example, let me just remind you that this is for educational purposes only. Definitely connect with your own experts, but here's an important part about connecting with experts. Experts can only give you advice up to the level of your understanding. And that's the third reason that the lack of knowledge can be such a costly state to be in. If you don't sort of already know what's possible, in many cases, your tax advisors or your investment advisors can't make you aware of it. They care about what is considered your level of sophistication, and they can only sort of provide you advice in alignment with where you demonstrate yourself to be. And that's why specialized knowledge is so powerful. And this is why you really want to engage with what I'm calling here the pizza principle. It's substituting for the idea of having specialized knowledge. But let's imagine we're at an event together and we're hungry and we decide to buy a pizza to eat. Well, because we bought the pizza because we're hungry, there's no tax advantage to that whatsoever. We're going to pay that money we paid, we earned, we spent it, and then we have to pay tax on it, even though it's gone, right? Even as contractors as we are. So that's what's going to happen. However, what if we instead decide to go, we're on a team together, or maybe we're on deck checks, and we're not especially hungry, or that's not the primary reason we're getting this pizza. We're getting this pizza because we decided we're going to use our team break as a time for mentoring as a group. And because we're mentoring as a group and we're talking shop, we're talking judging over dinner, well, now the meal has become a deductible food or travel expense. And now the pizza goes from being 0% deductible as it was originally to being half deductible. And I know what some of you are thinking. Some of you are thinking, Mark, if you take me out for pizza and we talk shop, I want the deductible half. It doesn't quite work that way. Even if we split the bill, we're each only allowed to deduct half of it. So now, why is it half? Well, the IRS assumes that you would have eaten anyway. And since you would have eaten anyway, they're just giving you a slight perk for making it a form of a working lunch or a business meeting lunch. And maybe because you would have eaten at home, which could have cost less, but now you're eating out, they give you some concessions. The IRS likes businesses, so they give businesses deductions. It's really as simple as that. It's that social policy influence once again. But that's still not all. There's more to the pizza story. Let's say instead there was a large 400-person side event, and it has caused everyone working the event to have to really buckle down, and we can't even go off-site. We don't even have barely time to eat. So instead, your team leader goes and buys delivery pizza to come to the event. Get this, it's true. If rather than sit down and dive in, we decide to stick around and eat that same exact pizza but have it delivered, well, now that event is 100% deductible under catering. And this is one of the reasons why I'm going to suggest, and in the next pick here, I'll show you a few, that you get some guidebooks. Because you see, we've had the same impact of eating a pizza, right? We eliminated some hunger, we got some calories, we participated in business, we either did or didn't discuss magic. Those were the only real differences. Like, our intent was the only difference. And it went from being not at all deductible to half deductible to fully deductible. And that you can only do once you learn how to do it. So let's try another one. You're out on the road going from event to event to event. You've lined up a few because you're a road warrior for magic judging. And this is a shirt that you're going to wear, and you're going to get it dry cleaned. So my question to you is that dry cleaning a tax deduction? And while you think about that answer, let me share something. When it comes to tax deductions, there's a general rule you want to be thinking. The IRS's general rule is if something is regular and ordinary for the conducting of your business, then it may be or likely is treated as a tax deduction, right? I love the comment that was said here, by the way. I'm going to show this from Scabbers. Scabbers pointed out that the amount of income lost to people every year is almost the amount of a Black Lotus. So if you've ever thought to yourself, I'd love a card like that, but can't really justify getting it, by learning to do just a few different things, you might just be able to get that for yourself. That's really, really solid. So our question here we're asking is, I get this dry cleaned, and is it a tax deduction? And I want to add right here, this is one of the things that was sort of odd in trigger warning again, or content warning again about the president. In the president's tax return, he deducted something like $30,000 or $60,000 worth of haircuts. I'm here to tell you, again, the IRS assumes you need a haircut anyway. You're not going to be deducting your haircuts. Let's not do that. Even though you might regularly and ordinarily get a haircut before you do some major events, that's not a deduction because it's not it's not directed to the business. Remember when I said, why are you judging? For the purposes of this training, it's to make money. It's because you're not a business if your purpose isn't to make money, right? So that's what we're doing. Well, as you can probably guess, the deductibility of this dry cleaning depends. Did you do it way before your travel with the rest of your clothes when it was convenient for you? Then no, it's not a deduction. It's just what you do to take care and keep care of your clothes. However, if you did the laundry during your trip, during those series of trips, or perhaps even immediately upon returning, then yes, it's deductible. But get this, not even this is the whole story. Once again, if you merely deduct this, and you deduct it, say, if you created an entity to do your judging and you had your company pay for your dry cleaning, because now it's a company expense to them, but now it's become a benefit to you. You may still be charged tax under the fact that it would be a benefit. So what you really want to make sure you're doing, here, let me just read this to you. But once again, there's a catch. If you incur travel expenses on behalf of your business, you don't want to deduct those expenses personally as an employee, because you'll be subject to that 2% gross adjusted income tax. But if you submit the dry cleaning bill to your business for reimbursement, well, now it's 100% deductible to your business, and it's not a benefit or perk to you. How do you learn these things? Well, you learn these things from these books that I'm showing you on the screen. They come out, well, like the J.K. Lasker's books come out every year. Some of the other things come out with less frequency. But they still give you some really clear ideas on the directions you can go. And remember, again, the fundamental premise we're operating under. This is your right to do as long as you're judging as a business. How do we know you're judging as a business? Well, the only way we know is if you report your intent. It's your intent that makes you judging as a hobby versus judging as a business. So let's move on to our next objective. Can you visit friends and family tax-free? Well, by now, I hope you've guessed it. If you're driving to see your friends because you want memorable life experiences that are going to last you for forever, there are no tax advantages, right? If you're just enriching your life, nothing. That's it. You don't get a thing. On the other hand, if you're using your car and you're judging business because you're driving to events, well, and you happen to, while driving to your events, either begin or end that travel with a visit of friends, well, now it is deductible, as long as the initial purpose. In fact, you can even do it a few times, as long as you always have judging business bracketing the memories. You're in good shape. The other thing is, there's a second catch. You have to be good at keeping records. Maybe. I'm not good at this part, so I do it differently. See, if you're really good at keeping records, then you can deduct the actual expenses. There are two methods to deducting car travel. Actual expenses is where you add up everything that it costs to operate your car. And then this can include, by the way, gas, oil, repairs, tires, insurance, registration fees, licenses, depreciation attributed to the travel. You take the total number of miles that you drove for business divided by the total number of miles you drove at all. So if you drove 100 miles for business and 1,000 miles total in that year, you're going to be able to deduct 10% of all of that expense. Every bit that you can prove, 10% of it is a write-off. But that record keeping is significant. If you want to know more about it, you can find in the IRS tax document, topic number 305 goes into how you have to prove different things from a record keeping standpoint. But I like it easier than that, okay? And so I do it differently. If you don't want to keep as many records, use the standard mileage rate. So that's the second way you can go with this. In 2019, the standard mileage rate was 58 cents per mile. This year, I believe it's 57. But it was 58 cents per mile. I judged in 34 events that year. So I justified 13,712 miles of business travel. Now, what is hidden here that isn't obvious is that of this 13,000 miles, it included 3 round trips from Chicago to Southern Florida and back. So 3 of those trips were trips to visit my family. And what I did is I worked events around the event. So I would either go to a judge conference, say in Georgia, or I'd work the Eternal Weekend, or I'd go to one of the Magic Fests, wherever was near where I was going. So that portion of the travel that was from home to the event was tax deductible. And then I could go from there, spend some time, go to another event on my way back. I did that 3 times. So what this meant by making this decision, by structuring my vacation the way that I did, if you think about it, that's $8,000 in additional deductions. And that's huge. Even if you are at the lowest tax rate, that's going to pay for 2 to 4 months of your car payment just doing this the right way. The other thing I had on here to remind myself, I use the GPS now. And one of the options on the GPS I can put is so it doesn't go through toll roads. And I thought about that as an analogy for avoiding taxes, because something that was funny, I found the ways that the road signs would indicate to go took you down the toll roads. But sometimes by choosing that option, it didn't add any miles and it didn't add any time to my trip. It just avoided a toll road. And that seemed like a great metaphor for what we're doing here. So remember, of course, your mileage may vary. I specifically have a hybrid electric car, so I'm getting 54 miles to a gallon. I'm really winning with that standard mileage deduction. If you have a bigger vehicle or with much lower mileage, you may be kind of stuck with doing the actual costs if you really want to win here. But again, even if somebody had been at the lowest tax bracket where they still are paying, you do have to kind of qualify by making enough money that you're doing any deductions. You can't just be doing the simple form. You have to be willing to file, have made enough that you're paying some marginal tax rate. But even at that 14.5%, if we go back to that nearly $8,000, you can see where you're getting, that's $1,000. You're making somewhere between 2 to 4 car payments, depending upon the cost of your car. So that's pretty solid. Depending on how you set up everything, or even if you choose to be merely self-employed in a side business, you can deduct some or all of the expenses on your computer, your cell phone, and much more. Again, what's that test? Regular and ordinary. If it's regular and ordinary in any business, it's likely deductible for you. And here's the key point. You don't actually need to make a profit as a judge. You merely need to intend to make a profit. And that's essentially the difference. So even if you have other work, if you have a full-time job and you have a part-time judging business, you could suffer losses in your part-time judging business that allow you to lower your tax burden from your full-time W-2 income. So that's very, very exciting, gives us a lot of opportunities. And that's where I'm going to begin the shift to the other side of the wealth building strategy using judging. If all you did was take that other career you have, lower your tax burden, and now you learn an important message, which is that it's okay for you to keep some money. It can be difficult, But the fact of the matter is, if you start with a budget, you probably won't even notice if you tighten that belt just a little bit. So let's talk about how you can keep some. 7 out of 10 freelancers are not saving for retirement. This is a big, huge problem. Some people wonder about whether or not Social Security will be there when different of us judges, you know, we have judges as younger even than 18. We certainly have judges that are already retirement age. But 7 out of 10 freelancers, which is what we basically are as a judge, aren't saving for retirement. So here's what you're going to want to do to change that and beat the odds. Search online for setting up a budget, because that's going to be the first thing. You need to know where your money is going now for 2 reasons. You need to know where it's going now to see where you might be able to snip off a little bit, tighten up a little bit, but you also need it to begin to identify the expenses that you're having as a judge that are regular and ordinary and can start being tax deductions. If all you did was continue to spend exactly as you are now, but get an extra $6,000 a year back from the IRS in the form of a tax refund because you've made strategic deductions, you're winning. You're winning, and you're doing better than 7 out of 10 of the other freelancers out there. Now, after you set up your budget, you want to pay yourself first. You want to put money away somehow in a way that you don't ever kind of notice it, because we've all been in a place where we have money in our pocket, and at the end of the day or the week or the month, it's not in our pocket anymore. But if it weren't in our pocket, we just wouldn't have gotten that one more Starbucks, our favorite Starbucks drinker. We wouldn't have gotten that one more item that we purchased as an impulse. We might not have gotten that newest secret lair, right? So even as an independent contractor, you can set up a tax advantaged savings plan. I'm going to use the Roth IRA as an example. And this is somewhat counter to some of the other messages I've been having, because the Roth IRA itself does not generate a tax deduction. Okay, thank you. I have 2 more slides, so we should be done real fast. You can't, this is a great question. So I'm going to answer this, even though I'll take all the other questions afterwards because our time is short. You can deduct mileage in a carpool. If you do, you've got to do all your record keeping and understand that theoretically the money you give to the person who's the primary driver, they're not supposed to deduct that part. If we share hotel bills, we're not supposed to deduct that part. It's one of the reasons why if you ever share a hotel with me, I always gift you the money for the stay. Just a small little thing. So look at these numbers with, if we could just save that $6,000, $5,500 of it into a year, here's what happens. It grows tax-free and it looks like this. If you just did it for 5 years and stopped and learned how to earn 5% interest, you see what happens after 10 and 25 years. If you learn to earn 7%, you can see what happens. If you learn to earn 10%, which really isn't that hard, it's sort of the historical average of the indices like the S&P 500. And then if you could really learn to earn like 20% from things like tax lien certificates or from even doing some really clever MTG finance, that's what you're looking at. Now, you can't do collectibles in a Roth IRA, but that's just a point. I'm going to leave that. I'm going to go back and leave that slide up when I finish, but my final one is to remind you to please complete the feedback form and join me in the other space with any questions. Thank you, everyone.